All right. Good morning, everybody. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's shortly after 10 a.m. Pacific, Friday, September 12th, and the first week of the NFL season is in the books. Hopefully, all of your favorite teams have done well. I know a couple of mine have not done well, but that's okay. We carry on.
My team didn't do well, and I'm still happy though. So
Yeah.
It is what it is.
So, we have football back as a distraction for our collective consciousness, and we'll see what this weekend brings. The tail of the tape in the markets this week was pretty positive. Speaking of tail of the tape, I just got to give a quick shout out. There's a big fight on Netflix this weekend, Canelo Alvarez. Check it out. It's free for all. You don't have to pay pay-per-view if you have a Netflix subscription. The tail of the tape, the tail of the ticker tape for this week was quite positive. Stocks, the S&P 500 up 1.7% on the week, and every day was positive, surprisingly. From the close of last Friday, the S&P was up every day this week. As we're sitting recording this podcast, it's flirting with being flat, just about up between 0 and 5 basis points. So we'll see how it closes it out, but the S&P has reached all-time highs once again, led by the technology sector, up 3.2% on the week. This rally was really catalyzed by strong earnings in the AI and data center front from several major companies in that arena, and a few deals were announced as well, suggesting that build-out is just continuing to be a huge percentage of the corporate investment in the United States that adds to GDP. I mean, we have some pretty interesting charts. Maybe we'll throw one up on this podcast showing that AI data center investment has gone from like 1% of GDP, the 1% of the investment component of GDP to like north of 5%. It's pretty interesting how big of a jump that's been over the past, 5+ years. So really driven by the technology sector. Consumer services, the second best sector on the week, up 2.25%. Interestingly, the third best sector this week was utilities, a bit of a contrarian play there, up 2.2%. And energy was up 1.7%. The loser on the week was the materials sector, down 31 basis points, and the consumer staples sector down 82 basis points. Those are the only two sectors in the red in the large cap U.S. equity market. Kind of looking at small caps rallied 51 basis points, so lagging the broad market. And the Russell 1000 value was up 62 basis points, lagging the broad market. Naturally, growth outperformed, with the Russell 1000 growth up 2.54% on the week as of the recording of this podcast. Looking over in fixed income land, we got quite a rally in the back end of the curve. We're sitting here, the 30-year Treasury yield has dropped 7 basis points, which naturally has led to an increase in the price of fixed income securities. So the U.S. aggregate up 36 basis points on the week. The government sector up 23. Mortgage-backed securities doing quite well. The best performing sector on the week up almost 0.5%. As the recording of this podcast, as interest rate volatility has diminished as well, which generally helps the embedded optionality there for our listeners. The corporate bond market did quite well, as many of the corporate bonds in the corporate bond indices have higher interest rate risk, up over 40 basis points. High yield bonds up 20 basis points. Bank loans, the weakest performer on the week, only up 15 basis points. And emerging market bonds performing very well, up over 60 basis points. So I think, quite frankly, the bloodless verdict of the market in the fixed income world was positive across the board, driven by a rally in rates. I will note, somewhat interestingly, that the curve has flattened slightly. From the 2s-10s has gone from 56 basis points to 50 basis points over the course of the week, with the 2-year moving from about 4.1% to or 4.01% as of the close on Friday last week to about 4.02, 4.03 as we're recording this podcast right now. So kind of interesting motion. We naturally have the Fed meeting next Wednesday, which is going to be a major event next week. And, the market's hoping for the SEP to suggest 3 cuts this year. We've seen the downward revisions that Kimbrough is going to talk about in the labor market. We've seen a kind of weak employment report. We've seen kind of inflation maintained and contained, I would say. And that all suggests or augurs for interest rate cuts. Now, the market wants 3 plus, but, we were debating this on the desk actually this week, and we generally think maybe the Fed's going to try and hew that road and stick to 2. We'll just have to wait and see what happens there. And last but not least, we move to the commodity space, and commodities gained 1.2% on the week. The big driver there was industrial metals and precious metals. Industrial metals up 2.6% and precious metals up 1.5%. The only loser was livestock, down 1.2%. Energy was roughly flat, up about 10 basis points. If you drill down into the subcomponents, WTI crude's trading at about $62.50 a barrel, up about 1.4% on the week. Copper up 2.3% on the week, and everyone's favorite pet rock gold up 1%, currently around 3,600 and let's call it $50 a troy ounce. Bitcoin up 3.44% this week, trading at 115,487, and the dollar depreciated slightly to 97.64. And that kind of wraps it up for the week. What do you think, Mr. Kimbrough? You have anything to add?
Generally positive week for the financial markets here. There were no big surprises. We'll talk about the economic data shortly, but no big surprises there. And like I said, solid fundamentals underlying it. So call it a positive week for financial markets.
Let's jump into the macro for the week then.
Yeah, let's do it. I'm gonna give you a little preview here. Give you the top 5 items we're gonna talk about this week. It's inflation week, so we got CPI on deck. We have PPI as well coming out. Also, initial and continuing claims for some labor data or some of our high frequency data. We also got the BLS releasing their prelim revisions, their benchmark revisions to the establishment survey data. It's a little more labor data there, although it's a bit in the rearview mirror. And then some soft data. We got University of Michigan sentiment data that was released today. So let's jump in. I'm going to go chronological here. We're starting on Tuesday. We have the BLS prelim benchmark revisions to establishment survey data. This is, the data that hits, this is non-farm payrolls. This came out with the prelim estimate of negative 911,000 jobs. That was versus estimates of negative 682K. Knee jerk, that just sounds pretty bad, but let me try and give you a little color to that number to, help give it some context. We went from, this is the 12-month period that ended March of 2025. So like I said, a bit in the rearview mirror, but we went from initial reports saying that we had created 1.79 million jobs. It's about 149K per month. And with this revision, this prelim revision, it's saying we're down to about 73K jobs added per month over that 12-month period. So cutting job growth basically in half. We won't see these numbers actually show up in the final NFP numbers and the actual NFP figures until February next year when they release the final estimates of these benchmark revisions. But on that note, I'm going to say I've seen a couple reports out there. I'm going to tamping this down a little bit and say I've seen a couple reports of folks that are suggesting that the final revisions will look a little bit better. No guarantees, of course, but some of that can be just historical context. 12 of the last 13 final revisions that we've seen were better than the prelim revisions. For example, last year, the prelim revision was negative 818K, and the final ended up, 598K. So there's some hope these numbers can get a little bit better, but we'll see when they come out in February. Last thing I'll mention in this report, the BLS did give 2 preliminary explanations for these revisions, and I'm going to paraphrase them a bit here. But the first is that the survey responses, when they went out to get the NFP data, the sample of companies that were providing this, the jobs data, they were reporting more jobs than what could actually be reconciled with the tax data with the government as well as unemployment claims. So there was a bit of an overestimation there in what was initially presented in the NFP surveys. And then of the people who were surveyed, or the businesses that were surveyed, the businesses that were doing a little worse were less likely to respond. So you had a bit of a bias towards businesses doing better, and then they were over-reporting their numbers relative to the government figures. So two explanations here, preliminary explanations given by the BLS as to why we could see this, why these revisions came to be. Moving forward, we'll get into some inflation data for the week.
Take that with a grain of salt. That's all I'll say there.
Yeah,
Take
you know
those
what?
numbers with a grain of salt.
I agree with you. This data is very fair. I keep saying a little bit in the rearview mirror. This is last year. We're already working in this. Look at the last 4 months of non-farm payrolls data, the establishment data. We're working with a very low rate. We know this is the low hire, low fire, low turnover job market. So it's not that big of a change. And the market reaction wasn't, it was basically nothing. Rates were up a few bips that day, but I don't know if you could attribute it to that report. So yeah, let's get into a grain of salt, but still, I'd say an important report just because it's one of the establishment surveys, or it's the it's labor data. So again, PPI, we have the month of August. Let's see, I'm gonna look at the headline number and the ex-food and energy number. Those both came in at 0.1%. That was versus estimates of 0.3 for both of them and a prior of 0.7. So decent deceleration there. Actually just pure on deflation there. And then you get the year-over-year numbers for the headline came in at 2.6% versus estimates of 3.3 and a prior of 3.1, while the ex-food and energy number came in year-over-year at 2.8 versus an estimate of 3.5 and a prior of 3.4. Knee-jerk, if you're just looking at those figures, while I generally don't want to cheer on deflationary inflation prints, it's nice to see that the year-over-year numbers came back down into mid-2 range. But looking under the hood of this report gives us more color for this. There's one category that jumps out more than any other, and that is the final demand trade services. That is the margin pressure number that we look to. And this was actually the largest contraction we've seen in that figure on record. Tied to, if we get really granular and look at the third decimal point, it was the second lowest. But I got data going back to 2013, and this was tied for the lowest print we've seen for this metric. And that would suggest we had a contraction in margins this month, or for the month of August. The actual figures work out to be about a 34 bip contribution, or a bit of a drag on the headline number. So
one thing that I'll say, Kimbrough, to this point is I've been kind of talking to various business associates, and one anecdotal data point that I found interesting to kind of support what you just brought up is I think businesses are scared to raise prices right now. They know the consumer's kind of strapped. They know that tariffs are hurting their bottom line if they're importers, but they also know if they raise prices 20%, their sales could go down 30, 40%. And they're just afraid. That's the general sentiment that I'm hearing out there in the marketplace is kind of businesses are eating the cost for now, and the economy isn't strong enough to really jack up prices.
I would think all the data we've seen thus far, for the most part, supports that anecdote. I mean, that's in this. I mean, that's why we look to another category in this report to actually try and keep this margin in perspective. It's the ex-food and energy and trade services. That one came through at a reasonable 0.3%, in line with the estimates, a little below the prior. But it's again, I agree everything you just said. Yeah, like this, that's what the data is reflecting. We're not seeing broad pressures inflation wise, but look, the people are trying to protect their market share, so they're absorbing a little bit of the margins. We'll get a little bit of that actually reaffirmed in the CPI data for August. The headline number came through a little hotter than estimates, came at 0.4% versus estimates of 0.3 and a prior of 0.2. While the core number, the ex-food and energy, came right in line with estimates at 0.3 and the prior of 0.3. This brought the year-over-year headline number to 2.9%, right in line with estimates, but a slight acceleration from the prior of 2.7. While core came right in line with estimates in the prior at 3.1%. Quick details on this report. Again, no big surprises here. Like a small pop in the headline number, but looking at that food actually this month, this is the strongest food print we've seen since January of 2023. It kicked in 6 bips to the headline print. You got another 4 bips from energy. There's your 10 bip spread between your headline and your core number on the month-over-month basis. But looking at core, it just missed the round, actually. It hit 0.35%, clearly under 0.35, or it would have been 0.4. But this remains elevated on the back of elevated core services, and specifically shelter. This month, there was basically half the contribution, or I shouldn't say half, say core services this month, it was up just about as much as it was last month, material in line with what it was last month. But the contribution from shelter doubled. This CPI print was lifted up a bit by an elevated shelter category, and also in the core goods, you saw a huge contribution coming from used car prices. Actually, about half of the rise in core goods is attributed to used car prices. So I want to summarize the CPI report in saying that yes, the numbers were still elevated, but I'm not seeing the broad-based tariff pressure showing up in this. And I'm going to support that with one more category from this report, and that is the core goods, ex used cars and trucks. So, look, I don't want to strip out all the things that matter in life, like energy and food and cars, but the cars and trucks has been a bit of a volatile number. So I'm trying to get a look at a broader set of goods. And this month, that number was up 17 bips, and that's right in line with where it was last month. And it's below where it was back in June when it was up, let's see, 32 bips. So I'm gonna just, yeah, this helps support that. Yes, there are definitely things being impacted by tariffs, but it's not showing up in a real significant fashion across a broad variety of goods. Companies are trying to hold back a little bit.
Yeah, and I mean, look, I think ultimately all this boils into the Federal Reserve is likely to cut interest rates next week, and this report gives them the wiggle room to do so.
Agreed. And so you know what? Let's wrap the week up here. We kind of covered the biggest ones. You know what? We got some of our high frequency labor data. The market's starting to have more of a focus on labor and less on inflation, as inflation data has started to calm down a little bit. Or as it isn't running away with the tariff fears. But this week we had a bit of a spike in initial claims for the week ending September 6th that came through at 263K. That was 28K above estimates, 27K above the prior. A couple explanations for this. One, this was the week of Labor Day. Shortened holiday weeks and seasonal adjustments sometimes can make this number be a bit challenging to make those seasonal adjustments work. But I think a bigger reason for this week's spike was out of Texas. We got a non-seasonally adjusted print of 32K coming out of Texas versus the prior 4 months. They averaged 17K very stably. Likely explanation for that, there was disaster unemployment assistance following floods in July. The deadline to file for those claims was September 4th. So it looks like there might have been a number of people in Texas getting in right before the deadline. And that gave us this bit of a spike in initial claims. If you took every other state in the country, there was actually, on a non-adjusted basis, it was down by a net 7K. So I'll say maybe a bit of an anomaly here in the data. We'll see how it comes out next week. But continuing claims came in steady, 1.939 million. That was down 11K from estimates, right in line with the prior. And finally, today, we got University of Michigan sentiment data. The sentiment came in below expectations, mostly driven by estimates, mostly driven by a decline in expectations. You know what? The inflation numbers were up a little bit on the longer term, but I'm not as concerned with that. I think the biggest takeaway from this was a chart that the University of Michigan highlighted, and it was dealing with labor concerns. And there was two figures that they posted. It was probability of losing a job during the next 5 years and the percent of consumers expecting more unemployment during the next year. And both those were, call it, at or near highs that we're only seeing either during COVID or the GFC. So just a bit of showing some fear in the consumer space for the labor market. But that's the biggest takeaway, I think, from this report this week. And that wraps up our week of economic data.
Thank you, Mr. Kimbrough. Yeah, I think that you made some good points there. I definitely think the University of Michigan sentiment indicator indicated suffering, at least from the survey participants. But we'll have to wait and see how that shapes out. I don't think it's like a very reliable forward-looking indicator.
Yeah, something to keep a thread on. It's
Yep.
get a feel for the direction of it.
Now, when we look at the interest rate path that can be imputed from the market, what we see is there's pretty much a guaranteed cut next week, according to the market. One cut priced in with over 100% chance, which means that that there could be a 50 basis point cut, but it seems unlikely. Still 3 cuts priced in through 2025. 3 Federal Reserve meetings left, so the market clearly wants a cut at each meeting. Well, we really have to focus on the summary of economic projections and Chair Powell's statements to kind of see if we can get insight into, the trajectory of interest rates. And don't forget to tune into CNBC to hear Jeffrey Gundlach dissecting that FOMC meeting next Wednesday. That's going to be by far the most important event of next week. So keep your eyes peeled for that. Tuesday we get retail sales. We do get the import and export price data, which we would like to look at. and we get industrial production, which is also useful to look at. But that FOMC meeting is going to be the big market mover of the week. So keep your eyes peeled for that. And then naturally, we get the initial jobless claims and continuing claims data on Thursday. And we get the broken clock, the leading economic indicator on Thursday. I don't know. Maybe we won't. It might make the top 5 next week, but I don't know. It might need to get cut from the team. What do you think,
Yeah,
Kimbrough?
I'm pretty skeptical on that one making the top 5 next week.
Yeah.
I do want to highlight the one thing for the FOMC. I believe we're still on schedule for the newest member, Moran, to be confirmed right before the meeting. So we'll see if, when it comes to the SEP, it's possible he is confirmed and part of the voting committee, and we will see where his dot lands in that SEP. That's going to be something that people are going to be keeping an eye out for next week.
Definitely a lot of drama in the internal workings of the FOMC, and we won't know exactly where his dot lands, but we'll see a new dot that if it's way down below, the market participants will speculate that that's his dot, but they don't label the dots in the summary of economic projections, so it's an anonymous forecast, and that wraps it up for the week.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/DoubleLine Capital. We've got some good stuff. We've got the JEG Webcast Survivor on DL.com and YouTube. We have Perspectives and Investors Framework for AI featuring Maria and Tina, DL.com and YouTube. We have a LATAM elections paper by Valerie and Nicholas on DL.com and LinkedIn. And we also have a Treasury briefing paper by Bill Campbell on DL.com and LinkedIn. So a lot of good stuff to check out. And then once again, the big one, don't miss it, is Jeffrey Gunlock on CNBC around noon after the Powell presser. And that wraps it up for the week. Have a good weekend.
Yeah, thanks. And everyone take care out there. Be safe.